What's going on, everyone? We have another filing to talk about out of FINRA. This one is SR FINRA 2021-030, and it involves trace reporting for Treasury portfolios. Let's go ahead and take a look. So a little bit of background. For purposes of the proposed amendment, a delayed Treasury spot trade is a transaction in a corporate bond that occurs on the basis of a spread to a benchmark, U.S. Treasury security, where the agreed upon spread is later converted to a dollar price by spotting the benchmark, U.S. Treasury security, at a designated time. For example, parties may determine to trade a corporate bond based on an agreed spread to a specific U.S. Treasury security at 10 a.m., but the dollar price is determined later at 3 p.m. when the parties spot the spread against the agreed benchmark U.S. Treasury security yield. The FINRA believed that a specific modifier to identify delayed Treasury spot trades, along with disseminating the time at which the spread was agreed, would both alert market participants that the spread-based economics of the trade had been agreed upon earlier in the day, as well as provide market participants with the ability to estimate the agreed upon spread. Purpose. So basically, again, we're just going to add a new paragraph, D4H, to require that a member append a new modifier when reporting a delayed Treasury spot trade. We have 2, add a new paragraph, C14, to require that the member report the time at which the spread for a delayed Treasury spot trade was agreed upon. Both the new delayed Treasury spot modifier and the time at which the spread was agreed would be disseminated through trace, together with other information on the transaction immediately upon receipt of the transaction report. FINRA believes that by specifically identifying delayed Treasury spot trades, the proposed rule change will enhance FINRA's regulatory audit trail data and improve price transparency for corporate bond market participants by identifying transactions whose price may not be at the current market for the security. They also believe that disseminating the time that the spread was agreed will further enhance price transparency by providing market participants with the ability to estimate the agreed upon spread. So, FINRA is also proposing a new modifier to identify portfolio trades. For purposes of the proposed amendment, again, a portfolio trade is a trade between only 2 parties for a basket of corporate bonds at a single aggregate price for the entire basket. For example, a market participant may seek to trade a portfolio consisting of 50 corporate bonds. The parties may obtain mid-market prices for each of the 50 component bonds as a framework for the pricing, and during the negotiation process, ultimately agree on a uniform spread resulting in an aggregate dollar price for the entire portfolio. In such cases, members must report to Trace a trade for each individual bond in the basket with an attributed dollar price for each bond, while in many cases, the reported price for each corporate bond in a portfolio trade is in line with the security's current market price. In other cases, based on, for example, the liquidity profile of a specific bond or other factors, the attributed price reported for an individual security may deviate from its current market price. The FINRA believed it would be beneficial if market participants were able to identify with certainty which trades were part of a portfolio trade because of the possibility that the reported price may not be reflective of the independent market for the bond. Now, the FINRA therefore recommended that FINRA amend its trace reporting rules to identify corporate bond trades, doing 3 of the following. Number 1, executed between only 2 parties. Number 2, involving a basket of securities of at least 30 unique issuers. And 3, for a single agreed price for the entire basket. And lastly, executed on an all or none or most or none basis. So basically, specifically, FINRA is proposing to add new paragraph D4I to Rule 6730 to require that a member append a new modifier if reporting a transaction in a corporate bond. Basically, they did all 3 of these right here except the 4th one. They did not include the all or none basis. Let's see why. FINRA notes that the FINRA also recommended that the portfolio trade definition include a requirement that the basket be executed on an all or none or most or none basis. One commenter suggested deleting the reference to most or none in this proposed prong because a definition of most or none does not currently exist in current market practice and the concept is not well understood. After further consideration, FINRA believes that moving this prong in its entirety would reduce the proposal's complexity without reducing the new modifier's informational value. FINRA is therefore not proposing to include an all or none or most or none prong as part of the portfolio trade definition. In essence, FINRA believes that the proposed rule change will improve transparency into pricing in the corporate bond market and enhance FINRA's regulatory audit trail data by specifically identifying delayed Treasury spot trades and portfolio trades, which are 2 types of trades where the price may not be reflective of the current market price at the time the trades are reported and disseminated. FINRA also believes that the proposed rule change will enable market participants and investors to better understand pricing for delayed Treasury spot trades by requiring members to report the time at which the spread was agreed, which will provide market participants with the ability to estimate the agreed upon spread for such trades. So basically, there's discrepancy in bond market pricing based on the pricing they're currently paying for in the spot trades. They're trying to figure out what's going on there and trying to give a reason and a rule behind why prices may differ from basically the market where it's currently trading and these Treasury portfolios. So that's it. FINRA 030. Y'all have a good one.